This is a quick introduction to a new indicator on incredible charts. Weinstein Stops are based on the concept from Stan Weinstein's book, Secrets for Profiting in Bull and Bear Markets, which was published about 20 years ago. Now, Stan Weinstein used a 150-day weighted moving average and suggested that the stops be moved up every time a new trough forms in an uptrend. Now, we've simplified the formula and instead use a weekly chart and simply move the stop up each week that the stop isn't triggered. The stop is basically set at the moving average. If we add a moving average here, you'll see a 30-week weighted moving average equivalent to 150 days. Weighted, let's change the color. Okay, you can see the stop follows the moving average pretty closely, except obviously when it's triggered, and then it reverses. Now, Weinstein's suggestion was to avoid whipsaws, not trading when the moving average flattens out. But we found this normally occurred a bit late, and you'd be in the whipsaw trade before the moving average really flattened. That's why we introduced the Twiggs Trend Index as a filter, and basically working on a 10-week trend index. When the trend index is trending lower, you wouldn't enter a new trade. And only when the trend line is broken would you actually look at re-entry. So let's remove the moving average and have a look at the stops progress up and are triggered on the week ending the 27th of June. So then you have a sell stop basically set. Not that we're taking short positions, but you can see the sell stop would be triggered, and then you whipsaw to a buy stop and then a sell stop again. So those are the whipsaws you want to avoid. You can see on the trend index it's trending lower throughout this period, and you use that as a filter. You don't take a new entry point until the downward trend line is broken. So at this point here, we would set a buy stop there, which would be triggered the next week and put you back in an uptrend, which continues until you're stopped out in the third week in October. Now, these stops are still pretty wide, giving the trend plenty of room to breathe. We have experimented with tighter stops, changing the period to as low as 10 weeks for the moving average. What that does is it'll run up a lot quicker and you get stopped out earlier. But as you can see, at roughly the same level that you would have been stopped out later with the 30-week stop. Again, the trend index is in a downtrend, so you would avoid making new entries until that reverses, which would come at this point here, the same point as with the 30-week, and you would enter at that level and your stops would ratchet up, and you would exit here at 762 in the second week in October, instead of waiting for a later stop on the 30-week below $7. You would be stopped out at 762. So quite a bit higher. So in a fast trending market, you can use tighter stops. But I'd suggest always using the trend index as an additional filter, just to avoid the frequent whipsaws that can occur with any stop system. Well, that's all for now. Thank you for listening.